And to encourage public sector pension funds to invest in overseas equities and bond markets is not necessarily new news. This was floated way back in February. It does, however, highlight the delicate balancing act that the Japanese face. If they did encourage overseas investment, then that, of course, helps weaken the yen, which, on the face of it, should boost Japanese export competitiveness and perhaps provide added growth impetus. But by the same token, it reduces the audience, as it were, for Japanese government debt, as these purchases will cannibalize demand for Japanese sovereign debt and therefore raise the risk that, in actual fact, interest rates will rise faster than the government will wish for, and that could possibly choke off the recovery. So this is the balancing act. They want extra growth, but they don't want higher interest rates, and that's a very fine line to tread. All right.
Comments from Dennis Lockhart last night, John Williams at San Francisco Fed. Again, I don't know if this is the markets trying to read something into comments on the end of QE. How is the market taking all this right now, do you think?
I think the market is perhaps getting a little bit ahead of itself in terms of pricing in the beginning of QE tapering. It looks to us as if much of the talk is around a September date for the beginning of tapering. Certainly the comments that we saw yesterday did support that notion, and perhaps even slightly earlier by saying that it would not be impossible really for tapering to begin through the course of the summer months. We think, however, that the data is likely to print a little bit weaker than the Fed expects, according to its own forecast. We think there's still some degree of fiscal drag set to come through. The debt ceiling debacle, which will run until September, is likely to restrain business investment in the US, and that should also constrain growth. So we think with data likely to print a little bit softer than the Fed expects, that tapering is unlikely before the very end of the year.
ECB is the context, of course, Thursday. What do you like in Europe right now? What do you like in southern Europe, in the periphery?
Well, it's somewhat a volatile outlook at the moment, and that specifically relates to Fed QE, and specifically whether the market believes the Fed is getting ahead of the curve or remaining behind the curve, and by that I mean the economic recovery curve, as it were, as it looks to reduce stimulus. If it remains behind the recovery curve and is going to reduce stimulus only slowly, then that should be positive for risk and should, for choice, see a continued narrowing of peripheral spreads and core and semi-core spreads within Europe. We think that is still the most obvious outlook, and we are long Belgium versus France in the 6-year sector in order to play that. But as I say, the outlook is certainly one of volatility. That's possibly the clearest trend going forward, as the market will reassess both the success of Abenomics, as we spoke about earlier, but also the Fed's timing of QE tapering on a data point by data point and speech by speech basis.